Good morning, everyone. I'm going to do a tech and telco preview this morning, obviously. So I was going to start just reflecting on what we've seen in the last month in terms of share price reaction, make some sort of broader sector commentary, and then talk about some key topical picks. So interestingly, in the technology space, it's pretty much played out already. We have seen quarterly or July trading updates from most of the names, and they've rallied quite hard. I won't go through this now, but I think the key takeaway from this, and as you heard from our corporate guest yesterday, Chris Stott, is there's quite a lot of relief rallies happening. So I guess if we're to assume what happened last month continues this month, there's a couple of names that I think could rally, potentially TPG with their results because they've said very little. And then we've got Telstra. Telstra will be known already, but the other two relief rally candidates are NextDC and Superloop, just really around certainty. So I'll send these around later, won't go through them now. But if we look at the technology sector as a starting point, we've talked for a while about it's really macro driven with the 10-year bond yields normalising, and we're actually starting to see some signs of that. Obviously, they spiked up to about 3.5%, back to about 2.7% at the moment. My view was they needed to sort of normalise around 2.5%, and we're certainly seeing things head in that direction, and that's probably the main thing that's caused a lot of the tech stocks to rally. For instance, we've seen Xero add 30% in the last month. We've seen Technology One add close to 20%. Neither of those have trading updates or even results in August. So I guess it just shows you the macro view is pretty supportive. Those that have provided trading updates, Data3 rallied 30% on better than feared. Megaport also rallied very, very strongly, 60% in fact, really on confidence that they don't need to raise capital. Not that we ever thought they did, but just shows you what's happening in that space. I think the big names, which is where we've tried to position people, have rallied the hardest. I think you'll start to see money move down the risk curve into some of the smaller names now. So they're probably the more interesting ones here. The things, I guess, fundamentally to think about from the technology sector are really the headwinds that we've seen for the last couple of years are starting to become tailwinds. The two biggest headwinds, number one, wage inflation. It's starting to lessen now. What you may not have seen is that 2-year highs are being sort of hit in terms of tech layoffs. These non-profitable tech companies are struggling to get funding and therefore obviously cutting their cost base as they move into survival mode. That's obviously releasing people back into the workforce, so that's helpful. At the same time, you're seeing sort of a shift. If you think about Bitcoin mining, non-fungible tokens, Web 3.0, all those buzzwords, there were a lot of people making a lot of money out of that over the last 12 months, I guess, before the start of this year. And now they've ripped up a lot of capital and coming back into the workforce. So that's going to help. At the same time, on the chip supply side, obviously, if you're losing money and selling some of the servers used for chip mining, what's happening is that's lowering the demand side. So you're not seeing new money come in and buy chips. So that's also happening. We've seen some interesting moves from some of the big chip manufacturers in the US. One recently just saying they're actually cutting CapEx next year because they're seeing consumer demand for PCs and smartphones decline. So that's interesting. That's the first sort of sign of things softening there, which is to be expected, right? If you think the last 2 years we've had abnormally high demand on that side. So that's softening. Manufacturing is starting to ramp up. But the one thing just to be conscious of, the big chip manufacturers, it's not until calendar year 24 at the earliest that their manufacturing plants come online. The 75% of the chip market is actually covered by the Taiwanese chip manufacturers. So Taiwan Semiconductors is about half the market and Samsung about 15%. They're the first, ironically, to set up shop in the US, and they're in calendar year 24. The American chip manufacturers are actually still sort of arguing with the US government about getting funding, so they'll be at least a year behind the Taiwanese. So that's really the only thing that's still a real challenge to work our way through. So that's sort of the sector. But those things are turning positive. Telco, you've seen this, I think, a million times. Just the price chart, it's turning positive is the key thing. We've talked about this for a long time, so I won't sort of harp on about it, but just the macro backdrop is getting much, much better. You're seeing price rises and a much more rational market. So if I then just jump onto sort of key names, obviously Telstra, they've got a result on the 11th of May. The actual result itself and even the expectations for FY23 are all very reasonably expected, I guess. Management have quasi-guided for the next couple of years, so there's a very tight spread in terms of consensus, so I don't really think there's much risk around this result or its outlook. The key thing, I guess, to be conscious of is obviously wage pressure. They've got a very large labour force, but I'm hopeful that can be covered with all the cost out they've done over the last 5 years, and also the fact that they're returning to growth or have returned to growth in their mobile business, which is more than half the EBITDA. Why we like this stock, it's really about the legal separation. It's been going on for a very, very long time, but we've seen some stuff passed through Parliament to allow that to happen, and at Telstra's AGM later this year, they'll put it to a vote. As you saw with mobile towers, effectively the investment community's valuing all of Telstra's earnings on about 8 times EV to EBITDA. Some of the assets, the infrastructure-like assets, are worth substantially more, 20, 30 times. So the potential for the re-rate here is really a very similar outcome to what we saw with mobile towers, which is as they separate the business legally and optically, hopefully somebody turns up with a big check and offers them a lot of money for 49% of those assets. Obviously, the other key thing for Telstra is change of CEO. So Vicky Brady, who has been the CFO for a number of years, is stepping into the CEO role on the 1st of September. She was very instrumental in their transformation project with the T22 and T25 projects. So I don't think she'll change things too dramatically there. I think it's largely business as usual, but that will be something closely watched. The other one that's quite topical will be TPG. Their result is out on the 19th of August. We've got them in on the 23rd. I think the result at the EBITDA line's largely expected, so I don't think there'll be too many changes there. But catalysts for this stock are really around the regional mobile sharing agreement with Telstra. They need to get ACCC approval for that to happen. There's expected to be a preliminary approval in August, and then the final one next month. So that would be a big win for TPG. We do have a hold on TPG, but I just thought I'd point on the next slide just the upside potential here. Basically, if you look back at this chart, it's mobile market share back to 2009. Vodafone used to have about 30% market share in Australia. They had a series of unfortunate events which basically, nearly broke the business, and they dropped 10% market share, and they've never gained it. If you think about what's happening in the telco universe at the moment, you've seen Telstra and Optus increase prices, and Vodafone have not. Obviously, there's a lot of consumers under pressure given inflationary costs, so higher costs of living. The relative attractiveness of the Vodafone mobile plan is getting bigger and bigger because of price rises from everyone but them. So there's a reasonable case to be made that looking forward, you could see Vodafone/TPG start to add mobile customers again. And with telco, it's a very much a fixed cost business. So if you can add customers, they're at 90% EBITDA margins, basically. So you could see a big uplift. But as you can see from that chart, we've seen them add no customers for the last 15 years. So I want to see that chart turn. That's really, you want to see proof that the consumer is prepared to start switching across to Vodafone. And then there is some pretty considerable upside that I would suggest not baked into our numbers. So that's probably the interesting kind of bull thesis. One we do have an add-on is NextDC. I'm not sure of the reporting date yet, but we are comfortable with the result and also consensus. We're below consensus for FY23. So I think there's upside risk to my numbers, and consensus is about right. So, broadly comfortable there. We know digitization and cloud demand is incredibly strong. So their demand side is covered. The supply side's been the challenge. Just this week, NextDC have opened S3, so their third data center in Sydney. It's a mammoth feat. It's an 80 megawatt facility. So getting that live is a big catalyst. It's kind of hard to sell something you don't have. Now they have it. The next step is M3, which is their third Melbourne data center, which is about to go live imminently as well. So all of a sudden, we're going to have a lot of supply coming to market. Much easier to sell what you've got. Then the challenge really comes down to the chip side of things. So what we're hearing is the cloud service providers, who are NextDC's largest customers, they're really struggling to get chips like everyone else. That causes problems for servers. Anyway, long story short, they're running their equipment very close to full utilization and waiting to get more equipment. So they've got to be able to get that equipment in order to obviously want data center space to put it in. But they've got typically reasonable visibility. You'd think close to 6 months ahead. So I'm still of the view that once they can get chips, they will place orders with NextDC. And that's really the main catalyst for this stock to kick things along. Those orders take years to ramp up. So that's not really what's going to drive the FY23 numbers, but I think it is what will drive the share price. And just one example worth sharing is at the end of July, the Victorian government signed a whole of government agreement with Amazon. If you're not aware, Amazon, most of their equipment is based in Sydney. Now they're going to set up a second availability zone in Australia in Melbourne. And what that means is they need to put their equipment effectively in 3 different data centers. It's their redundancy. They do things in triple. So point being, they need to set up a bunch of equipment in Melbourne. NextDC has 2 very good data centers, which I think are very likely to see, basically a big bunch of contract wins coming through for NextDC. So that's really the catalyst for that stock. Superloop, I know the network sort of heard this to death, but I do think it's a relief rally candidate. So to cut a long story short, we know their guidance already. We know they start next year with $30 million of EBITDA. The unknown is how much do they choose to invest going forward in sales and marketing. They don't give us the return on marketing spend, but we can put in a few different variations because we do know their marketing spend and we do know their net customer adds. What we don't know is their churn. That chart on the right-hand side says if you pick the middle table, which I've conveniently highlighted in grey, industry churn is about 24% per annum, so average customer sticks around 4 years. If you assume that applies to Superloop, they're effectively getting a 6 times return. So the lifetime value of the customer is 6 times the $1-ish, the dollar they spend in sales and marketing. So it's actually a really good investment. I don't think that the investment community fully understands that. So I've been trying to explain that, and hopefully that resonates. Point being, if they choose to spend more money on sales and marketing in FY23, that's a risk to the EBITDA number, but it's actually value creative. So the unknown for Superloop is what are they going to do with their sales and marketing spend next year, because that will impact the EBITDA for next year. So once we know that, I think the market, like we've seen with all of these other stocks, you should see a relief rally there. It's got a very good risk reward too, just noting they obviously sold their Singapore and Hong Kong assets, booked a $30 million profit on them, a pretty big mistake. Turned out pretty good in the end. They've got a net cash balance sheet and a large buyback that's in the market now. And Megaport, actually just a similar story. We've obviously already seen their result. It rallied an amazing 60% off its lows. But just a similar thing. I mean, the investment market's questioning the rate of sales in this business. If you look at the bottom left-hand chart, you can see they have been broadly selling about the same amount each quarter. So we need to see that accelerate. But people, I guess the cynics would say the return on sales and marketing spend is not very good. I've just had an attempt at working this out again. We don't have all the details. But if you look at the LTV, the lifetime value versus the customer acquisition cost, which is sort of that middle chart there, you can see it's also multiples. So depending on, there's obviously a lot of different ways you can cut this, but anywhere from 3 to 6 times is what I think the return is. So in other words, for every dollar they spend on sales and marketing, they get $6 back in gross profits. So they are actually spending wisely, and that's really the point of that. So I just wanted to point that out for everyone. We've got a hold on that one. And basically, I'll just wrap it up there. So basically, in summary, technology has really played out already. We've seen trading updates from everyone. We've seen bond yields start to normalize, and that's been the key driver of that sort of macro recovery. The quality names have rallied. So we've previously said you want to be in the big liquid names because they'll move first, and they have. I think you'll now start to see money come down the chain into the smaller names. I've got ad recommendations on Ansarada and AI Media at the smaller end of town. And you heard recently from James Phillis, who's just initiated coverage on Objective Corp, where he's got an ad recommendation as well. So there's 3 technology names and 3 telco names that we're happy buying into this reporting season of Telstra. As I said, an inline result and outlook, but likely to rally once they separate that business, and hopefully we get some catalyst there with somebody offering a reasonable multiple for some of those earnings. NextDC also expecting an inline result and outlook, but contract wins likely, and that's what will move the share price. And finally, Superloop, where we think the downside's protected. You've got an on-market buyback and net cash balance sheet. You've got strong organic growth and upside from M&A.